Hello, everyone, and welcome to the Chapter 2 sample problems. In Chapter 2, we are continuing with our learning about how to record transactions in an accounting system. So in Chapter 1, we learned about recognizing what parts of the accounting equation were being applied to record transactions or when transactions occurred. And today we're going to actually learn about how to record those. So the first thing we're going to zip through here is something that was covered lightly in Chapter 1, but requires a little bit more detail here. And that is how to recognize the different types of accounts that we might be seeing when we are recording transactions. All right, so we have our accounting equation, assets equals liabilities plus equity. And under equity, there are some subsections that we learned about in Chapter 1. There is owner, capital, I'm just going to put OWCA. There's owner, withdrawals, sometimes referred to as dividends. There's revenues, and there are expenses, right? Now, owner capital increases equity, owner withdrawal decreases, revenues increase equity, and expenses decrease equity. But what do all of these account types mean, right? These are all different types of accounts that we might have that are summarized here. So assets, those are our economic resources that we have available for future use. Liabilities are things that we owe that will require us to utilize or use up our assets in the future. And then equity is the portion of ownership we have left in our company after we take into consideration what we owe to outside parties, right? So if we have like $100,000 in assets and we owe 40,000, let's write down 100,000 in assets, and we owe 40,000 in liabilities to various vendors, the government maybe, etc., then that means that what we actually own of those $100,000 in assets is the remaining 60,000, which would be equity. Okay, so assets, future economic resources, liabilities are things we owe that require the use of future resources, and then equity is the ownership that is left over when we take into consideration our assets and liabilities. All right, so oops, didn't mean to delete all of those, but all right. And then when we talk about equity, right, we have capital, we have withdrawals, we have revenues, and we have expenses, okay? So of those equity types, capital is money that is invested into the company from by the owners. Withdrawals is money that is removed from the company. Revenues are when we create value through the activities within our company, often called sales, right? So the creation of value through a transaction within our company, sales of either products or services, or other activities that generate value. And then expenses are when we expend or use up assets, okay? When we use something up, okay? All right, so with that in mind, let's go through these different accounts and review how they would fit into our various account types. Again, I'll just put our assets equals liabilities plus equity, okay? So what we're looking for is this an asset, a liability, or equity? Well, we know that everything over here fits under equity. So anything that says expense, we can immediately go down here and consider whether that is actually equity. All right, so rent expense, we've used up the rent, that would be equity. Scrolling down here, insurance expense, we've used up our insurance that we maybe prepaid for, maybe not. That would be equity also. Franco Capital. Well, Franco is the name of the dude that is purchasing the company or starting the company. So this is going to be equity, an equity infusion. Furniture, that's something we buy that's used for the long term. We don't really use up furniture in one usage. It's typically good for more than a year. So that would be a long-term asset. Service revenues. Go ahead and pause this, by the way, and take a minute to see if you can fill these out on your own. Just skim through, try and get the easy ones, and then resume the video here and see what the answers are. If you take the 30 seconds to think about it on your own, that will, when you come through here, even if you just click through and put the answers in that I give you, that 30 seconds of thinking will mean that more of this will stick and you'll be able to use it in the future. So little learning science there for you. All right, so service revenue. This is our sales creates value. That is a subsection of equity. Prepaid insurance. So we haven't talked about this concept yet, but prepaid usually means that we've paid something ahead and somebody owes us future performance of some kind. So if I prepay for my insurance, I've paid in advance and my company owes me insurance coverage. If I were to say prepay for rent, then that would mean that I've paid in advance and somebody owes us rent performance. All right. If I prepay for advertising, then that means that somebody owes me some advertising services. So anytime you have a prepaid, that is an economic asset for future use. All right. Accounts payable. All right. So we purchased something on account. We didn't pay for it. So that would be a liability. Now, this one is a tricky one that always gets people, all right, when they're first starting out. So unearned revenue. So let's talk for a second about what makes up a revenue. So revenues are recorded when we perform some kind of value-added activity that results in the creation of additional assets for us. Now, that asset could be cash because somebody's paying us for the service or product that we sold them. It could be a receivable because they aren't paying us cash right now, but they will in the future. So they owe us money. That is another potential asset. On the other hand, if we flip that the other direction, right? If somebody pays us for sales of services or products that we have not yet delivered on, we have not created that value yet, right? So what that means is that somebody's paying us in advance for something and we owe them delivery or performance on that revenue. So let's say that I am a service provider and somebody pays me in advance to perform accounting services for them. I owe them either a refund or I owe them accounting services, right? So that means because I owe them something, unearned revenue that I have not fulfilled yet is actually a liability, okay? So same thing, like a really common example of unearned revenue, you buy your airline ticket in advance, you pay for it, and that airline owes you either a refund or a flight somewhere based on what you purchased, right? So they have a liability to you until you fly with them, okay? Same thing if I was on the side of the insurance company. If I'm an insurance company and someone prepays me for their insurance, in that case, I would have unearned revenue as an insurance company. So those prepaids and unearned revenue are like the opposite sides of the coin. So prepaid would be I pay someone else and they owe me. And then unearned would be like I'm the person who receives the prepayment and I owe somebody performance on that. Okay. Notes receivable. So somebody loaned me some money, or I'm sorry, I loaned someone else some money and I am owed that money. So that's going to be an asset. Someone owes me. Anytime you see receivable, that's typically going to be an asset, by the way. And then Franco withdrawals. So that's that capital withdrawal. Again, that would be equity. All right, so that is problem number 1. All right, I'm just going to clear these. And we're going to move on to problem number 2. All right, now hopefully you have watched the videos on how to make journal entries. If you have not, you need to stop this video and go watch some of those MyLab videos, or wait until we discuss the problem in class if you're in a live class. So this is a nuts and bolts, how do I make journal entries, right? So we had T accounts that we learned about in the video. So each account that we need to keep track of for each of these items, like, so in our previous, problem there, we had like cash that we used, or maybe we have a accounts receivable. These are called T accounts, right? So it looks like a T, and we show whether something increases or decreases on here, right? Now, thinking about our accounting equation, assets equals liabilities plus equity. Transactions on the left side here, which is the debit side, which we will abbreviate as DR, increase. So assets increase by debiting, and they decrease by crediting. So if I increase my assets, I'm going to record it on the left side here. And if I decrease my assets, I'm going to record that on the right side, which is a credit. Okay. Now, if I have a liability, let's do an accounts payable here. All right. So this is a liability account. Anything that's on the right-hand side of the accounting equation. So they actually increase by credits, and they decrease by debits. So if I have more accounts payable, right? So if people owe me more, or I'm sorry, if I owe other people more money, then I would record that on the credit side here, okay? If I pay off an account payable that I owe to somebody, I would debit that here on the left-hand side, okay? So decrease. So for a liability, it increases by crediting and decreases by debiting. And then for an asset, it increases by debiting and decreases by crediting, all right? And then, and we'll talk about expenses and revenues here in a second. But all right, so first, let's go through here. We are going to increase our cash. So cash is an asset. It increases by debiting, okay? Next, we have, oh, why is it skipping to number 11 on here? Interesting. Skipped the first half and went straight to, let's clear all of these. Where did my 1 through 5 go? Went straight to number 11. Oh, it's because we're on problem number 2. All right, never mind. Okay, so it started the 1 through 10 on question 1. All right, that's where my confusion comes in. All right, anyway, increase to cash is a debit, decrease to accounts payable. So accounts payable is a liability. So to decrease it, we would debit it, okay? So debits increase assets and decrease liabilities. Increase to owner capital. All right, so that is equity. Equity is on this right-hand side, so it's going to behave the same way here. It's going to increase by crediting, and it's going to decrease by debiting, okay? Increase to unearned revenue. Again, this is a liability, so if we increase that, we are crediting it, all right? And then a decrease to accounts receivable. So take a second, walk through the, the clues I've given you here and think about that. Which one do you think would decrease accounts receivable, right? It's going to be the same as cash, which is an asset. So decreasing it, we would need to credit that, all right? Let's check those answers. And then it's going to give us the next 5. All right, I'm going to wipe out some of these here with my eraser to get them out of the way. Just get this one, all right? I'll leave this one up here for reference. Increase to interest revenue. All right, well, we didn't do revenues yet, so let's draw a new one here. All right, so we had said that equity, so here's where it gets a little complicated, all right, under equity. So for equity, we would increase by crediting and we would decrease by debiting, all right? And we said that revenues increase our equity and expenses decrease our equity, okay? So therefore, if we have a revenue account here, revenues increase the same way that equity increases, which is by crediting, okay? And debiting a revenue would decrease the amount of revenues you're recording. And then for expenses, it's the opposite, all right? So expenses, because they are a reduction in equity, they do the opposite of what the other normal equity accounts do. So they increase by debiting and they decrease by crediting. All right, so with that, then we can do our next one here. So increase to interest revenues. This is a revenue account. Increasing revenues would be through crediting. Increase to rent expense. All right, so expenses increase through debiting. A decrease to office supplies. Now, office supplies, as we discuss it in these chapters, is an asset. So like thinking a closet full of office supplies that we have there ready to use for future use, right? So because that is an asset, to decrease it would be to credit. Prepaid rent, that is rent we have paid in advance, which is an asset for future use. We will future rental resources. So an increase to an asset is going to be a debit. And then an increase to notes payable. Notes payable is a liability we owe to somebody else. So a liability would increase through credit. All right. So that is question 2. Next, we are going to look at some journal entries in journal entry format. All right. Now, this is a very common format we've got here for journal entries. They want us to put accounts in here. We put the appropriate debit or credit for the account over here. And then at the bottom, we need to make sure that we put in a description of what the journal entry is for. So they give us a list of journal entries to make here. I'm going to put that right here. We see they line up by the date, so we can make sure we're looking at the right one. And then what we're doing here is the same thing that we did in our chapter 1 accounting equation exercises in like problem number 1, where we said, hey, what are the 2 things that are affected by this transaction? Well, now we're taking that information and we are putting it into a specific journal entry format, okay? So here we've got a business receiving cash and giving capital to Eloise Martinez, who is starting a business for EMB Consulting Services. All right, so we're going to increase our cash, right? And we are going to increase our equity. Now, remembering, I'm going to write this down again. I'm going to write down the accounting equation. Assets increase through a debit, which is on the left, and they decrease through a credit on the right. And liabilities and equity increase by crediting on the right, and they decrease by debiting on the left. So exactly the opposite of what is going on the other side, all right? So remembering that, if we are receiving cash, we are increasing our cash, which is an asset, so we will debit our cash. And that's going to be for the $10,000. Now, just like how our accounting equation has to balance, the assets have to equal the liabilities plus equity. All of our transactions that we record also have to balance. So our debits always need to equal our credits on every journal entry. So if we're debiting cash, then that means that we need to credit something else so that our debits equal our credits. All right. And since what happened here was we gave capital to Eloise Martinez, then that means it's going to be an increase in our equity here, right? And the specific account will be the Martinez capital account. And then lastly, we're going to choose our description here. So owner contribution is what happened here, okay? I am going to erase this part here there, just so I don't have quite such a big line there. All right, so that is our first transaction here. I'm going to move this up a little bit here. All right, next we are purchasing office supplies on account for $400. Remember that on account those are magic words that tell us that we are referring to either accounts payable or accounts receivable here, right? Purchasing office supplies on account, that means we're going to be increasing our office supplies, and we are going to be increasing or recording that we owe somebody else. So that would be an account payable. Okay. So we're going to debit our office supplies here for the $400. And we know that we have to have equal debits and credits. So I'm just going to plug that 400 right there. And since we know already from analyzing this transaction on account, we're buying something, it's on account, we're not paying for it. So we owe somebody an account payable for that $400. And then we're going to record here, purchased office supplies on account. So for all of these transactions, now that you kind of have the idea of the format, right? Because we've talked about whether we should debit or credit things, and we've talked about making sure your debits and your credits are equal, and recording the accounts and the title for the entry. I really recommend you take a second and try to take a stab at each of these entries before I record them in the video. Even if you're totally wrong, you have multiple attempts on the problems, and then this will also help you just formulate, do I know this? Do I not know this? And get an idea of what your understanding is as we go. And again, if you haven't watched the MyLab videos, please make sure you watch those because they walk through the process for all of these as in advance. So you'd have an idea before you come in here to these sample problems on how to do them. All right, now please write this down, this part about assets decreasing, increasing and decreasing, and liabilities. There is a lecture slide out there posted in the PowerPoints as well that shows a whole bunch of examples of what would increase versus decrease accounts. So please write that down and have it handy. You're going to need that for probably the next couple chapters here, just until you internalize this debiting and crediting part, which is a little bit abstract when you're first doing it. Okay. Here we are paying an advertising bill for $150. All right. So we've received a bill just now, and we're going to immediately pay the bill. So what we're going to do then is we're going to record that advertising expense, and then we're just going to reflect that we're paying the cash. Now, if you remember equity, right? Equity decreases our, expenses decrease our equity. So they go the opposite direction of an equity account, all right? They actually behave just like an asset account from a debit and a credit perspective. They increase through debiting and they decrease through crediting. So we're going to record our advertising expense here for the $150. And then we are going to credit our cash to show that we paid cash for that. And we're going to put our title down here, which is paid advertising expense. Okay. All right, the next journal entry we have here is receiving $1,000 from customers for services rendered. All right, so we're receiving cash, that's an asset. Assets increase through what? They're on the left side of the accounting equation, so therefore they increase by debiting. And so we're going to show our increase in cash, and then we are going to show that we have recorded revenues for the same amount. So service revenues, and then we're going to put our title. Performed services and received cash. All right, and then our last entry on this problem, and then I'm going to split this into two separate videos for everyone. Our last entry on this problem, Martinez withdrew $500 from the business. All right, so that's going to be a decrease in equity, right? So equity increases with a credit and decreases with a debit. So we're going to show this Martinez withdrawal is going to be a debit of 500. And then cash, which is an asset, increases with debits and decreases with credits. So that makes sense here. We're going to decrease our cash that we're withdrawing out of the business. And then we're going to put here that Martinez owner withdrawal. There we go. All right, so that is problem number 3. We're going to wrap on that in this video, and then the remaining 3 problems I will put in a separate video for you.